Welcome to The Explainer. Today, we're going to pull back the curtain and look at the hidden forces that are really moving money all across the global markets.
So if you've been watching the markets lately, you've probably seen some really mixed signals, right? Gold and silver are pulling back, the dollar's weakening, and crypto just seems kind of stuck. Now, on the surface, these look like totally separate stories. But what if I told you that underneath it all, a single, powerful narrative is unfolding that connects every single one of these moves? Okay, first up, let's talk about the dramatic action we've seen in precious metals. I mean, after an absolutely incredible run, a lot of people are asking the big question, has the rally finally hit its peak? The real shock came from silver. It recently plunged a staggering 10% in a single day. Now, a drop like that is more than enough to make anyone nervous, and it immediately sparked fears that this impressive bull run was officially over. But here's the thing. Market analysts are looking at this very differently. I mean, think about it. After 6 straight months of gains, a lot of people were sitting on some huge profits. So a big wave of profit-taking isn't just logical. It's a completely natural, even expected event in a healthy market. It's not a sign of a catastrophe. And this is where a really interesting concept called consolidation comes in. The theory goes that this isn't a crash at all, but more of a strategic pause. It's a period where the market just takes a breath, digests those recent gains, and essentially prepares itself for the next potential leg up. The big players might even be helping it move sideways on purpose. So, the real takeaway here is that this short-term volatility doesn't actually change the long-term story for metals. And that story isn't built on daily price swings. Nope, it's built on a deep, growing conviction that the global financial system itself is fundamentally flawed, and that's what's pushing investors toward hard assets. All right, let's move on to our second topic and see how this all connects. Because that falling dollar we mentioned, well, it doesn't look like an accident. It seems to be a deliberate policy with enormous consequences for pretty much every other asset out there. You know, in Economics 101, we're all taught that central banks are these fiercely independent institutions, laser-focused on their own domestic economies. But what we're seeing in reality, it's something else entirely. It looks a lot more like a highly coordinated, hands-on approach to managing currency values on a global stage. And this just illustrates the playbook perfectly. So, international partners reportedly put pressure on Japan about its weakening yen. And what happens next? The Bank of Japan steps right in and starts actively selling US dollars. The direct result? A weaker dollar, not just against the yen, but across the board. This kind of direct intervention just shatters the myth of a free-floating currency market that's guided by some invisible hand. Well, right now, that hand is very visible, and it belongs to central bankers who are actively managing exchange rates. So, why does a weaker dollar matter so much? It really all comes down to one critical concept: global liquidity. Think of it this way. A weaker dollar is like opening up a firehose of cash into the global financial system. It's just adding fuel to the fire. Now, all that liquidity has to go somewhere, and it often flows directly into what we call risk assets. You know, things like stocks, precious metals, Bitcoin, and especially emerging markets, pushing their prices way up. And we can actually see this playing out in real time. Just take a look at the Mexican stock market. It is in a clear, undeniable uptrend, and it's benefiting from this massive wave of global cash. And it's a really similar story over in Argentina. Its market was just moving sideways, kind of consolidating like we talked about with silver, and now it has broken out decisively. That signals a powerful new move upwards. And to round out the picture, the Brazilian market is also showing a very strong and clean uptrend. You know, when you see this same pattern across multiple emerging markets, it's a really powerful confirmation that global liquidity is high and it is flowing freely. Okay, so this flood of liquidity brings us to the final piece of our puzzle, and it's where this whole financial boom meets a massive structural conflict: the brewing war between traditional finance and the digital asset revolution. You've got two worlds on a collision course. On one side, you have the traditional banks, and they are terrified of a future where customers just pull their deposits out and move them into digital alternatives. Then, on the other side, you have the world of digital finance, which sees this incredible opportunity to tokenize literally everything, making finance faster and more efficient, but completely upending the bank's entire business model. And this leads to a pretty compelling theory about why Bitcoin seems to be struggling. even with all this liquidity sloshing around. The idea is that the traditional banking sector might be actively working to suppress its price. And the strategy? Create as much fear, uncertainty, and doubt as possible to slow down the public's migration over to this new financial ecosystem.
And you can kind of see why they'd be scared. This isn't just about losing a little business to a new competitor. For the banks, a mass movement of deposits out of their accounts and into the digital world, well, that represents a true existential threat to the very foundation of their model. So let's pull back and put all these pieces together. What do these three stories, metals, the dollar, and crypto, really tell us about the state of the market today?
The key is to see that these are not random, isolated events. The pause in metals, the orchestrated fall of the dollar, and the fierce battle over crypto, they're all interconnected symptoms. They're all signs of a global financial system that's in the middle of a massive and probably painful transition away from the old guard and towards a more decentralized, digitized future.
So if there's one thing you take away from this, it should be this. Right now, the flow of money is king. The direction of the markets, from stocks to metals to crypto, is being driven by these massive liquidity tides, which are being deliberately managed by central banks. If you can follow that flow, you have the key to understanding where things are headed. And that leaves us with a final and absolutely crucial question. As these powerful forces continue to clash and reshape our financial world, we have to ask ourselves, in a system of managed money and radical technological disruption, where will true lasting value ultimately be found?